really excited to have this webinar today from Morem and Waller, along with Jen Reise at North Star Law Group on creative capital raising. I'm going to let the team get right to it. As we go through, if you have any questions, please put them in the chat, and then I will read them out loud for all to hear at the end of the webinar. And with that, we will go ahead and get started. Thank you, Jen.
Terrific. Well, thank you guys so much. And thank you to Morem and Waller for having me today. I'm really happy to be here. I know many of you, but for those that I don't know, my name is Jen Reise. Yes, I know it looks like Reese, but I say it Reise. It's German. And I am, of course, a cannabis attorney here in town, especially working with Minnesota entrepreneurs who are entering the hemp and cannabis space. So today we're going to talk about creative capital raising, and here's my plan for how I want to tackle this large and interesting topic. I'm planning to present for about half the time, and then save the second half for more discussion and questions. After a brief overview, I'm going to launch into debt briefly, and then discuss topics related to equity, which I find are often the newer pieces for people, especially brand new entrepreneurs. As we go through, my goal is to give you an overview of how these capital issues usually work, i.e. not necessarily in the cannabis industry, to level set for people that are newer to these concepts. And then I'll introduce some challenges and resulting creative approaches that do work in the cannabis industry, or that I have seen work. I encourage you to ask questions as we go as well in the chat. All right, so go ahead and throw them in there. If I can respond to them in real time, I might. But generally, my hope is to kind of see what trends emerge and to answer a bunch of questions at the end. So fun to see folks saying who they are and what they do. I see we have a lot of entrepreneurs, a couple of associated professionals, and welcome to everybody that is here. And also, by the way, Morem and Waller has these slides, and we'll share them with folks afterwards, so no need to write furiously. All right, so let's get to it. So when we talk about how companies get the money that they need to finance the company, there are basically three ways. Generally, you'd see a combination of these approaches, and the balance between debt and equity is what we call leverage, right? So as individuals who maybe are first-time entrepreneurs, we're more familiar with debt, especially if you ever purchased a house or a car, right? Depending on your credit worthiness, a bank is willing to loan you a given amount of money at an agreed upon rate of interest with an agreement to repay it over time. So in the company context, it's similar, with the added complexity that the company is going to have to agree probably to certain restrictions, such as not allowing its cash on hand to fall below a certain amount, to give the bank comfort that it's not in danger of running out of money and failing to repay its loan. The bank will also have the right to call the loan, i.e. to say that the entire amount of the loan is due and payable upon some certain set of events, which are generally described as events of default in your loan documents. Finally, in an unproven company context, a lender is going to usually require personal guarantees of the principals against the loan. You've probably seen that as well if you've entered into leases on behalf of your company or so forth. That counterparty is going to want to make sure that they get paid by somebody, either this unproven company or somebody standing behind it with dollars, which is part of a painful, piece of being an entrepreneur. Also, if there's some way for it to secure its loan with an interest in real assets, then we'd be interested in doing that as well. So for instance, we see that in transactions to buy a building, for instance, right? The lender can also take a secured interest in the building itself, meaning if they're not paid back on the loan in a timely fashion, then they can foreclose on the building, and therefore they're more willing to make that risky loan. Okay, so that's debt. Second, alternatively, a company can raise money by selling its equity, i.e. selling shares of the ownership of the company itself. We're going to spend most of the time talking about equity because that's more unfamiliar, especially to the first-time entrepreneur. Third, as a company is successful in getting launched and getting going, ideally, it continues to fund itself with internally generated profits from the business, meaning that as an owner, you shouldn't depend on, like when you're making financial forecasts or whatever, you shouldn't depend on being able to take all of the profits of the business out as income to the owners, because probably a bunch of those profits are going to be needed in the business, right? To buy new inventory, to fund expansions. And really, that's a best case scenario, because you're doing that instead of taking on additional debt or selling additional equity. Finally, there is a fourth category, which is like government grants and loans. And I will talk about that briefly, but that is a little bit beyond the scope of this presentation. All right, so let's focus on debt for a minute, all right? So if a cannabis business is not plant touching, then they may be able to get a loan, such as a SBA loan or a cannabis business loan. Shoot, my windows just moved around. Let me redo that here. Okay, there we go. All right. In general, SBA loans are not available to cannabis companies, which is a big problem, which is a resulting problem of the real difference between federal and state law that we all find ourselves in, and part of why it is difficult to raise capital in the cannabis industry. But we have some other options. Okay, so some of the things that I have seen work are if there is some individual or company with money, within the orbit of the founders, a large investor or insider or a wealthy family member or friend, they can make a loan. And here's how I would do it. Negotiate with that investor these important pieces: the interest rate, the maturity date, meaning when is the loan due, right? Are any payments due before that maturity date, or is this just a promise to pay in 3 years or in a year or whatever? Is it secured by any real assets or guaranteed, personally guaranteed by anyone? And is it convertible into equity, and when, at what price? And we'll talk about that more in just a minute. Now, to do that loan from a large investor or insider, what you're going to want to do is paper that loan by entering into relatively short but formal documents of a loan agreement and a note. That means that that loan is documented in a way that it will survive. If one of the parties dies or changes their mind, such that it could be sued upon, it could be collected upon from someone's estate, etc. I have famously been trying to push the cannabis industry to at least napkin paper agreements to make sure that people understand and are on the same page up front, and then also that they can refer to that later as a documented agreement that they entered into, including if the parties change, right? Somebody dies or something. This kind of loan approach can also be a way to get a capital infusion to create a 50-50 partnership when one founder comes in with more money than the other founder, by the way. We can have both contribute some money as a capital contribution to the company, and then have the partner with more money also make a loan to the company that will then be paid back on whatever agreements are laid out in the loan agreement and note, and therefore they're 50-50 owners and the company has the capital that it needs. All right. Another related idea is the idea of a SAFE, which is short for Simple Agreement for Future Equity. This was very popular in Silicon Valley years ago. It was created by Y Combinator in 2013. And it's an interesting hybrid approach. Basically, what you do in a SAFE is that the investor is going to loan money, a known amount of money, on the understanding that it will convert to equity in the company in the future at a to be determined price. That price will be set by when the company goes back to the market in a much more formal way to raise money in its Series A offering. And so it's a way for founders to get that seed capital that they need before going through the more formal process of doing a full evaluation in a Series A offering. They were really popular for a while. Founders like them because they're easy to close, and they're fast. The documentation is easy, but the rub with safes is dilution. Because we don't know upfront how much equity this loan is going to turn into, founders can lose control of their company immediately upon that next round. And there's not an easy way to defend against that. You have to think about your deal on a pro forma basis. Make sure that you're comfortable, if the next deal was at this price, would you be comfortable selling that much of your company? What if it's 40% of your company? What if it's 70% of your company, right? We can also tinker with the safe documents to put sort of brackets around and kind of corral that. So anyway, I just want to note that for you in case you find safe documents online. There are definitely downsides and issues that you should notice in there. And indeed, in my experience, safes have been declining in popularity in part because of that. You can also enter into convertible note instruments that are not technically safes as well. All right. The other thing I want to note for you about convertible equity or convertible debt is that convertible debt is subject to equity standards, right? Because it can become equity on whatever events are described in the paperwork. All right. And so from a compliance standpoint, your convertible debt belongs on your cap table as a possible diluting event. And therefore it is going to cause, is going to be a matter for due diligence by anyone else who invests in your company as an equity owner, because they will also be diluted by these outstanding convertible debt instruments. And so they are going to want to understand them, okay? That doesn't mean don't do them. That means do them thoughtfully and knowing that they are going to be reviewed by other potential investors. Finally, I would also say there are third-party lenders out there that are offering convertible debt. Sometimes they frame it as warrants. Warrants are sort of like a right to buy stock upon certain conditions, sort of like options. I would be very cautious of accepting those offers, at least without seeking counsel. They often have very complicated provisions in them that end up with the lender getting a massive amount of your company upon a default. They can be predatory. And so just want to flag that for you as well. Okay, so let's talk about equity. Now, we have all thought about social equity provisions in the cannabis industry. That is not what I am talking about today, right? Instead, I am using the word equity to mean ownership of the company. If it is a corporation, then that means shares in the corporation. If it's an LLC, we generally think of that as membership units or membership interests. And so it's easier to use this general term, equity, rather than shares, because it includes both, whether you're a corporation or an LLC. So a couple of basic principles to get us started. First, investors buy equity as a bet on the future prospects of the company, right? So it's not based necessarily on the current valuation, though that's a data point, okay? It's really on the thought that the investors are going to put their money in hopes that then that expands the value of the company exponentially, and the investors' money will be worth much more at the back end. Second, there are lots of different types of investors with different goals and preferences. Some are active investors. They're going to want a seat on your board. Sorry, did somebody want to chime in? No? Okay, that's fine. You can also have passive investors. Passive investors, by definition, are largely putting their money in. They maybe want annual reports or whatever about what's going on, but they're primarily investing to see that back-end growth, or maybe they don't even get paid out until the company is sold or otherwise acquired. Equity can be divided into classes with different rights. You may have heard of preferred stock or Series A preferred. The normal type of equity is generally referred to as common stock or common units. Preferred stock means, that preferred stock has preferences. It gets paid out first, either as you make interim distributions going along in the company and or upon eventual sale or exit in the company. The preferred can also have additional control rights. For instance, it's common to see Series A preferred has to approve spending on capital expenditures above a certain dollar amount, or changes in the board of directors, other kinds of control issues that they want to make sure that they're at the table. Okay, importantly, but I wasn't ready to go on. There we go. Okay, importantly, issuing equity causes dilution to current equity holders. And my next slide is going to talk about what that means. And then finally, issuing equity implicates securities laws, even for private companies. And that means that there is significant liability for companies with both the SEC and with state securities regulators if they violate laws in how they sell securities. I should have said at the top, I am a securities lawyer by training, which is why I am excited to do this presentation for you. This is not a thing that most corporate lawyers know quite as much about. And so I'm excited to, try to scale this down to the cannabis industry and bring this knowledge to you guys. Mark, did you want to chime in here? I saw your mic come on and off.
Yeah, I was just gonna add all of what Jen is talking about from the accounting standpoint. What we see is a lot of people have a lot of different types of financing. I would say that probably the most common is that kind of unofficial debt area where it might be a loan from a family member. It might be agreements with investors in the cannabis space. And I would just really emphasize, have all of your documents in place, know where they are, make sure that you've reviewed them with someone like Jen, and have them in place, because we need those on the accounting side for sure. Because when there's little details like from interest rates and things like that up to what is your total capital, like helping use that to build out a cap table, they can get very complicated very quickly as soon as you start introducing investors. So I just really advise you, if you do that, to make sure that you have that you're being very meticulous with your records.
And they actually get, in my experience, more complicated more quickly when they are poorly documented, right? And then it's like, well, we're not sure when this is due, and we're not sure how much equity it turns into.
Exactly.
Okay. So a little paperwork up front can save us some hassle on the back end. All right, so let's talk about dilution. Okay, this is when you get to see that I'm a former law professor, right? And so I like to do hypotheticals. So let me take us through a little hypothetical. The numbers are not hard, I promise. Okay, so the idea with dilution is that when a company issues more equity, the percentage interest held by the existing equity holders decreases. They hold the same amount of shares, but their percentage interest decreases. So for example, let's look at ABC Corp. Okay, started by 3 founders as equal partners. So as a founding, how much does A own, you guys, as a percentage of ABC Corp? Anybody want to put it in the chat?
33 1/3.
Hey, there you go, Jude. Good job. Okay, so at founding, founder A owned 1/3 of the outstanding stock. Okay, but now let's imagine that they sell 1,000 shares to new investors. Okay, hopefully for a nice good chunk of money. Oh, here I said $1 million. Okay, how much of the company does A own now as a percentage?
Depends on their operating agreement, doesn't it?
No.
No. Okay.
No. We can calculate it based on what we know. Oops, that's not what I meant to do. Yeah, there we go. Okay.
Yeah.
They own the same amount of shares, but the denominator has changed. Okay. The denominator is all of the outstanding shares, which has now increased to 2,500 shares. Okay. So it's 500 divided by 2,500. 20% doesn't look right to me right now, but that's right, isn't it? Oh my goodness. I think that's right.
That's right. That's right.
Yeah, that's right. Okay, yeah,
You got
okay.
it.
Actually, yeah, let's get the accountants in here. Come on. All right. Okay, thanks, guys.
Right.
Okay, and if it's helpful to think about it as a pie chart, we can look at it that way as well. All right, so dilution, okay? Dilution, like cutting up a pie or having a glass of whiskey and putting some more water in it, right? You have the same amount of whiskey, but any given sip is going to have a little less whiskey. Dilution. Okay. So one of the important things that we are doing with cap tables is tracking who owns this thing. And then, for instance, if convertible debt converts, who will own this thing? Or if we do this sale to investors, how much will people own, and so forth. Okay. One of the things that I am passionate about is trying to make sure that founders keep control of their companies, even as they raise capital even as they raise the capital that they need to fund their companies. So here's the big takeaway with dilution, okay? Compared to borrowing money, selling equity can feel like free money to founders. But it also means that the founders no longer own as much of the company, which is crucial for both the financial outcomes and for decision making. Okay? And so that's why we can say dilution is the cost of equity. All right, let's talk about some other fundraising options, both equity and non-equity approaches. So we've talked about safe agreements. We also talked about debt, and we could reintroduce the term bridge loans, which is a common way to frame those kind of loans from founders or major investors. A bridge meaning to get you to profitability or to get you to the point where then you can raise more from the market. For instance, a bridge loan through licensing, I think, is going to be an important piece for many of my cannabis clients. Okay, other ways. The US does have crowdfunding. However, this is going to be to accredited investors only, and you have to use an approved crowdfunding platform. I have not seen seed touching companies use crowdfunding successfully, but if you were a non-seed touching company, this might be an option as well. So an equity stake is an interesting idea. This is something that one often sees like in medtech, for instance, where a partner company who already has money or is already started in the market might take, let's say, a 30% stake in a small company to help them get started and to get some sort of, preferential pricing on services, back and forth later and so forth. I could see that potentially being something that would work in the cannabis industry as well. Let's talk about some non-equity approaches. So one can do non-equity crowdfunding. Okay, we know that as what Kickstarter does, right? I'm going to start a brewery. If you, give $100 a month, then you get, this many cans of whatever, after they are produced. Again, with all the rules on sale and transfer of actual cannabis, I think that gets really tricky for like a dispensary model, but it might work for a non-seed touching company, someone that was offering some sort of services or consumer facing product that was not highly regulated. Here's an idea that I do really like in the cannabis industry, and that's something like pre-funding distribution agreements. Okay, so here's how that would work, sort of related to that Kickstarter idea. Let's say I need to raise a certain amount of capital in order to produce my product, to pay for it to be bottled, for instance. I can enter into contracts with the stores that I would eventually be working with to sell those bottles, and have those stores go ahead and provide me that capital up front so that I can get the bottling done, and then I deliver the bottles to the stores that have already paid for them, and they sell them to their customers. That's a way that we can use pretty limited capital in a closed ecosystem in a way to keep things moving. Another one that I have seen be pretty successful in the cannabis industry is the friendly real estate investor strategy. again, this requires somebody to have money in your ecosystem. But once you find that person, for instance, buys a building, and they can get a normal loan to do that, but then becomes a friendly landlord to the cannabis business. So the cannabis business has a space to operate and a landlord that is not, suspicious of what they're doing because they've already had those negotiations up front when they agreed to work together. The business is going to pay the investor landlord through a lease, such that the landlord gets, a consistent source of funds in that way. And then, of course, if the business fails, the real estate investor still has their real property, which they could then resell and do something with. So it has less risk for the investor than a simple equity investment in that same company. And it also is more helpful to them because it solves their real estate problems, at least to some degree. If you already own real estate, you can get some money out of it through what's called a sale leaseback. A sale leaseback means that an outsider or even an insider buys the property from a company and then enters into a lease and leases it back. That's, again, a good way to get cash out of a company, or to split the company up for purposes of 280E compliance, which my accountant friends can talk a lot about 280E at other times and places, I know. Because the real estate, of course, is not subject to 280E in the way that it's tenant, manufacturing, or growing, or retail tenant would be. All right, and then finally, I would be remiss if I did not mention the last three options here. One, of course, is grants. I and others are anxiously awaiting when the state will finally roll out the Ken startup and other grants that were created in the HF 100 program. Those have been slow to kind of come to fruition, and one of the things that I'm intensely curious about is what kind of organizations will be distributing those grants. Usually the way that Minnesota does it is that the first thing that happens is that nonprofits and community organizations apply to the state to be grantor distributor of the monies. And then the state chooses which of those grantor distributors they're going to work with. They get a pot of money. Then they turn around and develop a grant application that entrepreneurs and companies can apply to get those grant monies. And so the fact that we have not even seen that interim step makes me nervous about how much longer that's going to take to get the money all the way out to the entrepreneurs. But, we will see what we see on that. Finally, bootstrapping is the fun name for the idea of the founder who keeps other employment while building and invests, some of their own capital to be able to grow to a point where hopefully they could finally quit that day job and or raise money from others. But that initial bootstrapping phase is a time-honored technique. And then finally, of course, reinvesting profits once you have some. All right. I have just two more slides. Just looking to see. Yeah, please.
I'll just mention, since you mentioned 280E, I won't go too deep, but there is a lot of conjecture out in the right now with regard to 280 and how rescheduling may affect it. I would just say let's just wait and see what happens, because we don't know when to really quickly. It's possible that if the federal government reschedules cannabis from Schedule 1 to Schedule 3, that could have effects on whether 280E applies or not. But we really don't know when, and if it happens, what kind of lawsuits will come out of that. So I would say on that point, just keep doing what you're doing, assume that it's here for now, and just be patient, because things will change, but not overnight.
Thanks, Mark. Yeah, agreed. And if you don't know what 280E is, let's talk later, or Mark and Betsy can help you understand, because it is a significant headwind for plant touching cannabis companies, not companies selling hemp derived, as many of you are now, but for companies once you get the cannabis license. All right, so how do we raise capital? What are the steps? Let me just talk you through this, okay? You're gonna start with having a strong business plan, including financial forecasts that show your use of proceeds. How do we develop financial forecasts and what should be on them? You're gonna need a good accountant like Morem & Waller to help you put those together. You're also going to want to have a very clear idea of who is on your current cap table. Do you, for instance, have 3 founders, like our hypothetical earlier, who own equally, or what? Okay. And the classic way to do that, to have a clear cap table, is to enter into an operating agreement. This assuming you're an LLC. If you're a corporation, it would be called a shareholders agreement. And usually the last page, the exhibit A of that agreement, is your cap table. That operating agreement, by the way, also is going to figure out, it is going to help you guys figure out as founders and agree on paper how you make decisions together and what happens if somebody dies or wants to leave, which is important to get papered before that happens. All right. So you have this strong business plan. You have your financial forecasts and your cap table. First, internally with the other founders, determine what you're offering to investors. Are you thinking you want to do an equity raise for up to 40%? Are you thinking that you're really looking for that bridge loan from an investor? Think about what you want. You don't need to develop it with great specificity because different investors are going to have strong preferences about what they want, and it's going to be some back and forth. But it's helpful to go to the market with a sense of what you hope to find. And then you are going to have a lot of meetings usually. Usually this is a frustrating process for entrepreneurs of talking to investors about your ideas and trying to find a fit. Depending on whether your idea has, some sort of proprietary intellectual property-ish kind of pieces of it, you may want to have those meetings under an NDA, a non-disclosure agreement, or confidentiality agreement. Finally, you get an investor who is really interested, okay, who is excited about what you are doing and who tells you that they want to invest. Are you ready? No, you got a couple more steps yet, okay? Usually the first ones, and these two kind of go at the same time, is to develop a term sheet. And a term sheet is a way to try to figure out, do we have a deal in concept before we go to laying out the definitive documents. And so a term sheet would often be maybe 2 pages saying how much money the investor would invest, on what terms the debt would be, or for what equity, and is it preferred or common, and what other agreements there might be, control rights, timing, is it dependent on licensing, things like that would go in the term sheet. You should bring in a lawyer, at least a corporate lawyer, if not a corporate and securities lawyer, at the term sheet due diligence phase, if not before, because they can help you understand what these investors are asking for. And if you are dealing with a pretty experienced investor, help you understand sort of the pitfalls and avoid some of the more predatory things that they could put in the fine print. If you are dealing with a experienced investor, say a family member that has some money to invest, you also need a lawyer to help you write that down in a clear way that protects the parties and protects from future confusion and problems by when you get to the next raise, as we said. Okay, so at the same time, you're also doing due diligence, all right? And investors are always going to frame this as they're doing due diligence on the company, right? They want to understand what is the plan, who are the players, what are the risks to the idea, and what have you accomplished so far. I would also encourage you to do due diligence on your investors. What else have they invested in? Are they looking to be active or passive investors? What kind of value do they potentially bring to the company besides their investment, if that's on the table, right? Some of these people might be strategic partners or important advisors to the company. Some of them might be people who have very different goals for your company than you do. And bringing in an investor is a little bit like getting married. It is hard to get out of. It is important who that person turns out to be when the chips are down. And so this due diligence phase is a time for you to kind of get a better sense of who they are. Okay, finally, and so after the term sheet, then you proceed to doing definitive documents and to closing. So definitive documentation is a general phrase. So it might be a loan agreement, it might be a stock purchase agreement. It depends on the structure that you have chosen. And then finally, you close, which is when you actually get the money. A lot of people think that you get the money earlier. For instance, when you get the yes from the investor, unfortunately, no. There is more work to be done. Now, there are ways to do it more quickly than other ways, but usually there are more steps to be done. All right, I want to introduce one more complication here, which is, talking to folks who want to get licenses in Minnesota. This is really complicated to figure out how to sequence this vis-a-vis the timing of the licensing process. If assuming that your business is dependent on licensing. If your business is not dependent on licensing, for instance, selling to home growers or setting up a service business or something like that, then you don't have to go through licensing, then you don't have this additional complication. But if you do, oh man, it is really a trick to figure out, can you raise now when your whole business is subject to licensing? What happens to the investor's investment if they don't get a license? Are you going to refund their investment? Or are you asking for monies that you're going to have to spend in order to get through licensing, in order to like submit a quality license application to the state? And that's going to affect what kind of investors you can ask for what kind of money. I have seen some of my clients come up with a plan B. If we don't get licensing, then we will X. Then we will rent our space to someone who did get a license. Then we will stay in the hemp-derived space, etc. And it's possible that investors would be willing to ride that roller coaster with you as well. Otherwise, you may have to wait to fundraise, or at least wait to close to see if you get a license. And that's what, yeah, Alexander, you said, can you raise with a contingency based on license approval? That's basically what that would be, is to wait to close until you have the license approval in hand. Fortunately, we are not hearing from Minnesota that they're going to require people to have, a large amount of capital like at their fingertips in order to apply for licenses, which was true in some other states. So really, we're more just talking about how do you get the capital you need to put in a quality license application and then to stand up the business once you get one. All right. So last slide. Legal due diligence that savvy investors ask for. I have seen many times that companies do not have key corporate documentation in order until they are asked for them by an investor in due diligence. And that makes you look like you do not have your ducks in order. In fact, an inability to supply that information could sink a deal. And I have seen it sink a deal. All right. So as you're setting up your company and your business plan, have this stuff ready and at hand. Okay. Your filed articles, probably articles of organization if you're an LLC, a fully signed operating agreement like we talked about before, showing your clear cap table on Exhibit A, and being ready to answer the question, do you have any other agreements that give equity potentially in the future? Options, warrants, convertible debt, etc. So another way to say this is clean due diligence starts at formation. And that is what I am helping a lot of companies do right now. All right, so let's proceed to Q&A. What other thoughts and questions do you have for me based on this? And I'm going to look back at your questions.
Okay, yeah, there was just one,
Mhm.
Jen from Ross. He asked, for retail operations, will it be or is it expected to be required that any building being used is owned free and clear by either the operators or the landlord?
No, I don't think that that is required. it's more a cannabis business sometimes has trouble finding a landlord that is comfortable with the risks associated with a cannabis business. And so I was suggesting that friendly real estate investor as a way to deal with that risk, but I don't think that it is like required that, you know, um, that it's free and clear as part of the license application or anything like that.
Ross's follow-up question, do we know anything about requirements for liquid assets available for Minnesota cannabis businesses?
I have not seen anything in HF 100 or OCM say anything about requiring liquid assets. But I will obviously be watching very closely.
Jesse Harper asks, what is the standard interest rate for cannabis loans?
Ooh, I don't know that there's a standard rate, and it would depend on whether we're looking at a somewhat cannabis friendly bank like Bridgewater or Park Square Bank are both banks that have said that they are interested in funding the cannabis industry. Or of course, there's, you know, the kind of private loans that that we talked about as well. I mean, I often do what I think of as like a friendly loan, right? We want people to get paid, but like we're doing it not for major investment. And I would usually do that like a couple of points above the, you know, the sort of general interest rate, which is kind of a lot in a rising interest rate environment. But you got to think about what your maybe wealthy investor could earn, you know, how else could they be investing their money, right? What could they get from investing in alternative places and then give them a little more than that. Yeah.
There's a comment here just about running into investors who are worried about licensing the most. Can you speak a little bit about that and your experience with that?
Yeah. Sorry, I started skimming ahead while you said that, Katie. Oh no, multitasking fail. Okay, so you teed up the question about contingencies based on license approval.
I was just saying that,
Mhm.
what is your experience? I've heard this from individuals as well, running into investors who are worried about licensing. How
Mhm.
do you advise people as we get into this?
Yeah, this is really tricky. I think you kind of have two ways to go about it. You try to find an investor who is willing to take this ride with you, right? They're betting that if you get the capital that they have, then you can put in a credible license application and hopefully get that license, and then they'll have been, you know, in on the ground floor. Or they could lose everything. And are they willing to make that bet? Or a corollary might be, or then we'll pivot to plan B, which we're both not as excited about, but is okay. You know, and so then they might be willing to invest now. I think there are going to be a lot of investors that just wait on the wings and then show up as soon as licenses are granted. My firm is actually hoping to do like a Shark Tank kind of event soon after that to try to help pair the successful licensees with all those investors that have been waiting on the wings. That's something that I've been thinking about a lot. It's a tricky situation.
Yeah, I was gonna say, it seems like a situation in which networking and just being in the industry and being around and speaking to new people is really valuable when looking for new investors.
Mhm.
The question here from Andrew Tucker, which state is North Star Law licensed in?
So I'm a Minnesota attorney. And so my advice about debt and equity, I think, has application nationwide, but I only take clients who are Minnesota entrepreneurs or who are otherwise need advice on Minnesota law.
Are there common or what are common expected returns for investors in cannabis?
You know what? That is such a great question, Alexander. And I like that you say, I know it's not like tech where it's 10x type returns. And that is part of why we have a capital problem in cannabis right now is because maybe 5 years ago, the venture capital firms were really excited about cannabis, right? It's a brand new market. They can get on the ground floor, and they were making some pretty big investments in some companies that got really big really fast, some of the MSO companies. And they lost their shirt. Cannabis doesn't make 10x returns. It's a plant that has to be planted. And it's a retail play that like takes a lot of capital. And that just wasn't realistic for venture capital to think that those returns would be there, and they were not. And so venture capital has gone back to being very unhappy about cannabis. And so now we're back in these kind of like, yeah, other creative capital raising strategies.
Thank you so
All right. I see a recording is going to be made available. I didn't know that. That's great.
much.
All right.
Are there any other questions at this time?
And do y'all
Or-
have any questions for Mark and Betsy?
I was
Because they
gonna
know
say, if
lots
Mark
of
and Betsy
things
want to join us, if there's
that I
any-
don't know. Yes,
any
I
comments?
love, as a qualified corporate and securities attorney, having really great cannabis accountants to work with, people that really understand how to structure a business with 280E in mind, and how to do that kind of bookkeeping and accounting planning that will help entrepreneurs maximize their success.
And I would say we love having attorneys too. When the questions get to be about these types of things, we always say, talk to an attorney about that. So works both ways for sure.
Definitely. Yeah. We have separate and distinct expertise. Yes.
Exactly.
Places I recommend to network in the Twin Cities. So I am a big fan of the Canna Connect events and the Minnesota Cannabis College. There's Canna Connect 4 is coming up on Saturday, April 4th, I want to say. And
6th.
6th. Thank you.
Yes.
Thank you, Mark. All right. And we will be there. Actually, we have 3 big conferences coming up in Minnesota in April. The second is the Minnesota Hemp Growers Co-op, now renamed the Minnesota Cannabis Growers Co-op, and it's going to be down in Mankato in maybe April 10th or 11th, something like
Yep,
that.
you got it. Yep.
Okay, Wednesday,
10th.
I think.
Yes.
And I think that'll be a great B2B event that a lot of people are going to be going to Mankato for, including myself. And then finally, at the end of the month, we have our first big national conference in Minnesota. This group called Lucky Leaf is coming in from outside, and I think it will be an interesting blend of Minnesota-based companies and entrepreneurs and hopefully investors meeting folks from out of state who are all of those things.
If I could just make one recommendation, Jen, that a great place to start when you're thinking about how much capital to raise is with that financial projection, as Jen spoke to in her slideshow. And not only will that give you an idea of how much money you're thinking you're going to need to raise for your project, but in conversations with potential investors, really shows that you have the business acumen required to be successful, and will raise potential investor confidence in you.
For sure. Yeah. Whenever I talk to people and I say, how much money are you looking to raise? And they're like, oh, as much as I can. That does not look like you are a serious person with a good plan. Even if it's true, which, I respect, but it is much more impressive to have a detailed financial forecast that shows how much money you need to raise and how you would use that money effectively to set up a business that would actually make money.
We had another question from Davis Bonk about advice for farmers as the licensing becomes more clear.
So, advice for farmers specifically. I mean, unfortunately, I don't think that we're going to be planting large amounts of seeds that are in fact cannabis seeds this summer. Home growers can grow. I'm hopeful that possibly the caregiving growing will get approved by the legislature, but we'll see. We'll see if that has traction. I don't think that we'll be at the point where people are going to be able to transition over anytime in this growing season. I mean, we can grow indoors in greenhouse too, I guess, but yeah, and I guess as a, think about which license you would want to apply for too, right? Like the micro and the mezzo license both include growing under certain square foot caps. There those numbers for indoor and outdoor, in addition to the large scale growing license. So you can think about sort of how big of an operation you want to have and what license makes sense.